I think the economic recovery is still at a very sort of modest stage at this point of time. It's a very nascent recovery. The growth data was showing signs of improvement a year ago, but we have not seen any further acceleration in terms of the macroeconomic data, and most of the high frequency indicators that we are getting suggest that growth has sort of flatlined over the last 2 quarters or so. So it's still very early days in terms of the economic recovery itself. The key parameter that I think becomes very important to monitor at this point of time is really a revival in the investment cycle. If we just track the announcements on the investment cycle, the trajectory has turned higher. But our own sense is that for investments to actually fructify and to sort of turn growth supportive, the first stage is that actually corporate India's deleveraging needs to get completed. And that at this point of time still seems to be running slightly behind schedule. Government policy has been supportive in terms of addressing a lot of the issues of stalled projects and large capital investments which are not fully functional, but it's still work in progress, and therefore we think the first stage will be deleveraging, and only after that will all these investment announcements as well as perhaps some of the stalled investment projects come to fruition. I think the chosen path in terms of reforms has really been more of incrementalism rather than anything dramatic or path-breaking in terms of changes. Certainly there has been some attempt to reform and bring in new laws, including, for example, the land bill, which is still sort of under consideration. But some of the other laws related to auction of coal, auction of mineral have etc. been passed. Higher FDI has been approved in insurance, which also required a legislative change. But I think the approach that the government has taken in terms of incrementalism means that therefore one will need to be patient to see the positive impact of this get reflected in the economy. I also think that perhaps the speed with which the government has moved has perhaps been slightly slower than what one might have hoped for. The sort of typical honeymoon period that any government enjoys in its first 6 months was perhaps not used as much as it could have been, particularly in terms of resolving some of the issues related to, as I mentioned earlier, the stalled projects and the large number of investments which are still lying half finished and need to get completed. So I think in that area, honestly, progress has been very slow, and that's one reason why the economic recovery itself has been slow to come about. The macroeconomic vulnerability is certainly an important indicator to kind of keep track of, simply because growth in India has in the past, we've seen, had cycles which are pretty closely associated with the health of those macroeconomic variables. If you go back in history to 2012-2013, there was clearly a period of time where our fiscal deficit was careening out of control. The current account deficit was well beyond what was a comfortable level, and finally consumer inflation was also a significantly high, such a high number that it was actually a drain on the economy. If I look back at what has been achieved over the last 3 years, the fiscal deficit has not really come down to what we would call a comfortable level, but directionally it's moved in the path that one would want to see. The current account deficit has come down to a very comfortable number, and consumer inflation has come down by our own historic standards to a comfortable number, and more importantly a number at which the RBI is now willing to be more supportive in terms of its monetary policy decisions. So I think clearly the macroeconomic stability that we have achieved over the last 3 years puts us on a very strong wicket as compared to perhaps some of the other economies in the world, be they emerging markets or for that matter even developed markets. But macroeconomic stability is a precondition. It is a platform for us eventually to build on in order to get to the desired objective, which is a higher and sustained rate of growth. So, macroeconomic stability is desirable, but eventually it has to be, capitalized on by the economy in terms of converting it into higher growth rates. And I think that is now the second part of the challenge which needs addressing. So, our thought process at this point of time, given what has happened to valuations, because valuations have moved up quite significantly over the last 2 years. In fact, even if you go back to December 2011, the markets have almost doubled from December 2011, and most of this has been driven by the change in the valuations. Based on this, when we look at the market at this point of time, honestly, the valuations are not giving us a very clear direction in terms of areas that we would like to be overweight or underweight on, because a lot of the attractive areas have already seen that run up in valuation. Having said that, I think purely from the point of view of a earnings recovery in India, we would like our portfolios to have a slightly pro-cyclical bias built into them, and to this extent our favored areas are financials and also the consumer discretionary area. Not so much industrials, simply because even though this is economy sensitive, in our opinion valuations there are no longer in the attractive zone, and secondly we think the whole capex cycle in terms of a recovery is prolonged for the reasons that I mentioned earlier, which is that first comes the deleveraging and then comes the revival in the investment cycle. So we prefer the financials and the consumer discretionary as pro-cyclical areas. But again, in the context of overall market valuations, our thought process at this point honestly is to run a more balanced portfolio approach, because again, the case to really go significantly overweight or underweight sectors is not so much about the narrative or the story behind the positioning, but it's about how attractive is that area in terms of the valuations vis-a-vis the growth, right? So that's the trade-off we are looking for. And right now, given the current market context and valuations, it's not a very obvious trade-off. So which is why we are preferring to focus more on getting the stock picking right, rather than focusing on getting that sector allocation into so-called attractive areas. As I mentioned earlier, I think the key thing that any investor has to look at in equities is that first of all, it's an investment class which you need to invest with a long-term perspective. Secondly, if there is one important indicator that tells you how attractive markets are, it is valuations, and the valuations are more important than the narrative. The reality is that valuations have gone from a 10 to 15% discount to the long-term average in December 2011 to almost currently, as I speak, a 22% premium to the long-term average. In our opinion, this essentially then poses a challenge to investors in terms of their returns in the more sort of near term, and any investor who's looking at equities from these current valuations, which is close to 20x on a trailing basis, they need to have a 5-year outlook at least when they're looking to invest in equities, because the historical pattern is that if you want to earn the threshold return of about 14-15% as a CAGR return from equities, then from these kind of valuation levels the outlook needs to be at least 5 years plus, and that is when probabilistically the odds swing more dramatically in your favor. Whether honestly, if you look at the market on a 1 to 3 year basis, from the current level of trailing valuations, the return outcomes based on past data have not been in favor of a very good outcome for investors. So we really think investors looking at the market today need to look at it from a 5-year perspective. Don't look at the rearview mirror of the strong outperformance that equities have generated as an asset class over the last 2 years. That may not be the benchmark based on which you should be taking your investment decisions for the near future.